Hey everybody, this is Mark Coe for Commodities Guy, January 15th, 2017. Just wanted to take a look at a few markets coming into the week of January 16th in front of this presidential inauguration here in the U.S. Friday, January 20th. A little more of an exciting week here. We have Fed Chair Yellen speaking a couple times. We have ECB middle of the week, and then we have the inauguration here on Friday. Slow start in the U.S. with the holiday on Monday, Martin Luther King Day here in the U.S., and then we pick up, as I said, a little more activity. So let's take a look at levels. I like to look at levels, really refer to them as my basis for the analysis here, and I like it in the sense of it's market generated information. And what I mean by that is the market is telling me what it wants to do at certain levels. And so follow through a little and I'll point out what I'm talking about. So the first thing I want to mark here is the daily chart for the S&P, and looking at the highs that were put in middle of December. So I'll call this top edge, and all I'm referring to in top edge is consolidation. So the market can really do three things. It can mark price higher, it can mark price lower, or it can consolidate. And in a consolidation, you can call it consolidation, sideways trading, lots of ways to refer to the same action. But essentially what I'm looking for is the top of that consolidation and the bottom of that consolidation. And this gives me the look going forward. And so the way I refer to this is to say, what is the decision the market is making at these decision points? And there are so many ways to analyze the market, but this is the way that I find the most beneficial to my trading. So again, a daily look at top edge. What is the market telling us? Well, what it's telling us at this level is that sellers have been willing to come in, and you can call it profit taking. You can call it shorts being put out, although I wouldn't tell you at all these top edges you're seeing in the S&P that you're seeing a ton of short activity, but you can certainly look at the selling that comes into the market. And the result of that selling, so initially the selling that comes in mid-December manages to move the market off of 72.5 highs. It manages to move all the way down to this low of 22.28. No closes down there. I'm very big on the closes, but this is really the bottom edge I'm using, and I'll call it more in this 22.30, 35 range for the bottoms. The closes are coming in here at 36, so somewhere in that 6 to 8 point range. It's a range. It's not one tick, and that's one mistake short-term traders will make, is judging everything by one tick. I will look at things as a zone. So I will do multiple time frame analysis, which I think is very key. And ultimately what it does for me is it puts me in a position of strength. So when I go doing my analysis every morning for the commodities, every evening for the FX markets, I'm trading from this position of strength. I'm analyzing where am I strong and where am I weak. So if I'm to go long side S&P at this bottom edge, all I have to do is let it break and close below, and I'm out. That's where I'm wrong. If I were to go short side this bottom edge before a break, I'm not a very strong trader, which means I would have to let the market trade back above some 35, 40 points before it really proves me wrong. And that's a mistake a lot of short-term traders will make. They will chase momentum rather than finding levels. And what you see that really moves these markets is big money. The big money can only get positioned in places that make sense to them. So they're not chasing the market. They may add to positions, but where you see the real big decision points occur, it's big money that pushes it there. So let's just take a look at this action here in the S&P. So we have top edge action. So middle of December, top edge. End of December, beginning of January, put in this low here, which again comes from kind of the 8th of December low. Matching, same low. So one's 12.27 3/4, one's 12.28. It's essentially a matching low by one tick away here. So that's your bottom edge. I'm using this level basically pulling to the closes, and so it gives me a little zone of about 5 points. So it's a nice little trading range, 40-point trading range. Most of the action for this trading year in the S&P occurs a lot tighter. So look, there is intraday activity below this, but for the most part 2260 is holding on a closing basis. So look how tight that action is getting. So what is that doing? You're not rejecting off of these top edges. You're accepting those higher prices, so it's keeping pressure on that top edge. When you see the failure of selling to come in and actually power that market lower, it keeps that pressure up here. And so again, with the upward trend pressuring top edge, the expectation would be if you get through this top edge, especially on a closing basis, you're in store for higher prices. Until that top edge is taken out, especially on a closing basis, this is the battle zone. So rather than picking, I think the buyers are going to win or I think the sellers are going to win, I'm going to let the market determine to me who's going to win. The only two places I'm going to come in here and play is if I'm going to take long side trades, it's going to be bottom edge. And if I'm going to take top side trades, it's going to be top edge. And that's it. And what that does for me, it allows me to keep risk reward at a favorable level and understand that I don't need a lot of market movement to tell me I'm wrong. And any rotation successful in my favor is going to start to pay me more than I'm risking. And that's the whole idea. So again, I just wanted to give a little daily background on S&P, 2268 to 73 top edge action, 2230 to 35 bottom edge, and a lot of stuff in between. You see what's happening over the last 5-6 trading sessions in the S&P futures is that you're getting this really tight action all right around the 60 to 70. You've had some quick moves, some quick volatility below it, but nothing that's managed to close. And now, again on Friday, you close right up near the highs. And so that's the action. Now let's take it down onto a shorter term, and let's see how would the day trader or maybe the swing trader approach that, right? A lot of people are not going to analyze these markets on a day time frame, but I think even if you're trading them on a short-term time frame, you have to know what's here. Right? This is bigger money. These are more important levels. But if you take that down to, let's say a 4-hour look, let's look at it, that same level on 4 hours, and we're going to get a different picture. Okay? So now we can come into this 4-hour look and we can define our levels a little bit more. And so what I'm doing, again, I'm pulling from top edges to places where the market actually moved. And this is what we're seeing. So this is the highs over here on the left. These are the highs mid-December. And this is that level pulled across. You see throughout, just in front of Christmas, just in front of New Year's, the market was unable to take out these 2270, 73 levels on even a 4-hour closing basis. Then the first week of the trading year, we come in on the 6th of January. Big bull candle takes us up, and the market doesn't hold. So the idea would have been up here to look to be long for further upside movement. It fails. At that point, I know I'm not correct, and I can look to exit those longs. Until we break it again, the only two trades for me would be if I'm sell side up here, top edge, or some type of bottom edge to get long side, and that's it. So what that trading does for me, the analysis tells me strong upward trend, bottom edge. The preference would be to look for long trades up into it, and that be more of a profit taking. This would be more of a fading mentality, calling for sell action within the S&P. So that's more of a medium term look. But think about the way you're approaching these levels. So mid-December, you get the highs. Now you get the level where right in here, 13th, 14th, 15th of December, sellers come in and drive this market lower. Not enormously, but 20 plus points. So do I want to look at that same level? And that's all it is. It's the level where the market came in and sold S&Ps. Look at the next two runs up to this same level, right? It holds to the level. I mean, you're talking a 4-point range in the S&P, 66 to 70. Look how it contains it. So the first move into 66 yields a move down 15 points. The second move into 66 yields a move down to 28. So that's a 40-point move, all with what? Basically 4 to 6 points of risk to tell you I'm wrong there. The next time up there doesn't work. So you have one 15-point move, one 40-point move, one let's call it 5 to 7 point where you would have been stopped out if you're using that same look. But what I'm focused on is trading from a position of strength, which means I'm not chasing the market up here saying, oh, the market has to go higher. The market doesn't have to do anything. The market never has to do anything, and ultimately it's the market that's correct. So one of the hurdles that a short-term trader will have is they need this to work out immediately. One of the benefits of the longer-term traders, they say, look, I'm gonna work this level. So think about it. Long-term has been able to work this level for a month now, and this level has been level, 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 level. Now tell me the difference here if I start to look and say, this level, the reaction was what? This level, it was 25 points. This level, it was 15. This level, it was 40. This level, it was 10. This level, it was 15. So the moves lower are now getting smaller. We're not making topside. We're not breaking the topside yet and managing multiple closes above it. We had one little test here on the 6th of January. But now the sell moves are getting smaller. And these big absorption candles, what you see going on here, these are stops being scooped up by weak longs. So think about it. Think about the short term, the day trader, even the swing trader. You know, you say, wow, I got a really smart level. I recognize this level. I don't need Mark to tell me about it. 2260. I take it. I'll put my stops at 57, 52, 53, whatever it is. You know, I'll work for the next move up to 2,300 in front of the inauguration and then let the market sell off. What do you think this candle does that takes it below all this support? I mean, that's all it did was wipe out anybody that got long from here to here with tight stops. They're gone in this move right here. They got tested here on the 11th, but they got taken out on the 12th, only to watch the market what? It absorbed all this selling action. So anybody that had weak stops in here, they're done. Only to watch the market be trading, you know, some 20 points higher. 20 points higher. That's it. So understand strength positioning versus being weak-handed. And that's all this was, is weak-handed longs. That's it. And now we're back at test levels. So going forward, this becomes a key level to open the trading week, 2270 to 73 on top. So the way I would look at it going forward, I'm going to pull these two highs on the 6th of January, pull those over. Those are going to be an area of reference for me, but this still becomes my key because we failed to sustain above it. We tried it on the 6th of January, but failed. So there's now a cluster between 77 and 70 that I'm focused on. And if we start to get closes above this 73, it looks very promising up top. If you see the opposite of this absorption buy up on top, that's going to be negative as well. So don't get yourself pigeonholed and say it can only go one way. Understand, plan out your scenarios. If the market is to trade higher, how can I get positioned? If the market is to trade lower, how can I get positioned? What is my bias going forward? So for me to start the week, there's a lot more potential for volatility in this trading week. Again, there's more news. There's more political events going on. It is ripe for profit taken in the S&P. It is, in my opinion. It's ripe for profit taken in the S&P. But I want to look at it very objectively and say, well, what are the levels I could look at? And if I'm not correct in saying, well, it's very ripe for profit taking, if we are going to squeeze this last leg higher, or let's just even say another leg higher, where could I get positioned? So right now I have a bottom edge and I have a resistance top edge. If I get through that resistance, I want to look at that as now support. So those are the spots I would look to get long side. All right, let's take a look at crude oil. Going into this week, I'll pull up my crude oil chart here. All right. And we'll have the contract roll, but I'll just look at the February for this analysis. So the big levels, again, just to inform anybody that's new to my analysis, the big levels I'm watching here in crude oil, I'm looking at it as a range to start the year. 55.20 on top, you know, that's my area, my zone. 54.85. I'm really looking at the 20s because that's what held last go around, but it did extend higher on that gap higher on the 11th. We did extend up to 55.44. So you always have to take that into account. Again, I would caution against looking at one tick and saying that is the tick. Now, this is the level my subscribers and my followers had last week. This 75 area, and you see where that was marked from the 8th of December. All we did was look at the reaction What was the reaction the last time we traded a 50, 75, 76 in early December? The reaction was almost $5 up. It was almost a $5 move higher. The next time we tested it, is that not the same reaction? Right? So all this stuff in the middle is that. It's consolidation in a wide consolidation zone. This is top edge. This is bottom edge. This is consolidation. That's what it is. You have to start to recognize highs, lower highs, lower highs, lower highs, but this is still the bottom edge that created almost a $5 move higher. So ultimately, do I want to look at one little zone? And that's what it is. I mean, this is within 5 ticks of this low. 5 ticks. Can you imagine how strong of a trader you are if you're able to analyze a zone within 5 ticks? It's pretty crazy. But that's what my subscribers had. They had that zone highlighted days in advance. It's not like they're looking at it hours after the fact. It's days in advance. I promise you that. So what I'm saying is you have the ability to find these levels and know where you want to be positioned. Trade from strength, and that's what we want to do. So going into this week, S&P at a very crucial level. Crude oil, it's in the middle. It's in consolidation zone, maybe a bit of no man's land. So you're going to look at shorter term levels if you're going to short term trade. Bottom edge action, right? Where are you strong? If you break this 52, where's your next level? It's down here at 50.75. It's going to look like a different picture if you approach 50.75 again because you failed to take out rotational highs. So that's what you need to be focusing on for crude oil for the week ahead. You need to look at battle zones, not at all the stuff in the middle and think every tick has to be traded. Trade from strength. Don't be your broker's best friend. Pinpoint accuracy, and that's what you're trying to do. You're trying to position yourself for upside reward versus what you have to risk. So, so for the week of January 16th to the 20th, again, this is Mark Coe. Thanks for listening, and I hope you guys enjoyed it. Cheers.